welcome guys. Welcome guys. I appreciate you guys are on time. That's what's up. Tonight we'll be jumping into indicators. We're gonna be talking. There's tons of them out there. For those who don't know, we're gonna just take it from step one, and just talk about indicators on how you can use that as a piece to your overall trading strategy. Um, so I'll be jumping into the screen share soon. Reed, you want to add anything to that to just like kick it off, or?
Now, welcome, guys. We're gonna get into indicators today. We're looking forward to it. Yeah. Other than that, let's take it away, Glenn.
Roger. Okay, cool. Introduction to technical indicators. Boom. Indicators. So we're covering this new series. Last week we started talking about patterns in the market, identifying two different types. Went over ascending and descending channels, how to start them up, identify it, and potentially trade off of it. And so now we're gonna move on to tonight's topic, chart indicators. And this is strictly just a tool for you guys to use when you are going into the trading week and setting up your charts. So technical indicators, they're heuristic, big word for me, or pattern-based signal produced by the price, volume, or open interest of a security or contract used by traders who follow technical analysis. Technical indicators, just to sum it up, it's somewhat of it is based off of price. Strictly, it's based off of price or volume, and then it reflects, like for example, if you're trading the Dow or if you're trading a USD yen pair, it is just focusing on that price action, and it's creating some sort of different translation of price for you. So some examples are going to be RSI, Bollinger Bands. Who has seen these? Does this look familiar so far? Nobody? Okay. Charles, probably
Yeah,
you
they
got
do.
some. Yeah. So these are things, see, these are different types of indicators that are available for everyone to use. Whatever trading platform you want, think or swim, trading view, regular free charts. I think Gemini might have some, but these are tools for us that we can use. RSI, Bollinger Band, MACD, EMA. So like there's tons of them. There's a whole library, and for our it gives us access. It's accessible for us to use in our trading, right? So we're going to be talking about today, focusing on two types of indicators that we both use, Reed and I. And then we're going to pair it up with live charts and just break down each indicator. So feel free to take notes, screenshot if you can, just so that it'll be able to learn easier, right? So exponential moving average, that is the first indicator we're going to be talking about. It is a very widely used indicator, popular, as you would say, and it's very simple. Very simple. It's a moving average that assigns greater weight to the most recent price data. It is using the current price action and creating some sort of plot or line that you will see on the chart when we go into it. So so exponential. There's going to be different types of moving averages you'll see if you're using a chart, and we'll show you guys that there's different types of moving averages. The reason why we use exponential, it could be preference, right? Like, how did you end up with EMAs, Reed?
Actually, first started off with EMAs. One of my first. I think like when you download or you go onto TradingView, a lot of indicators are already there. So like, I didn't start with trading view, but FXCM, which is a brokerage, they had their own trading charts. So it came with a bunch of indicators, and I just happened to leave the exponential moving average. I applied Bollinger Bands. A lot of what you showed there, I probably tried about 75% of them, and it can become very like confusing when it's too much. So that's how I started it on it. How about you, man?
Yeah, I when I started out, I was going down the list, bro, and I was just throwing it on the chart and just seeing what it does, right? Oh, what does this button do?
Yeah.
Um, and then I used to use the simple moving average, um, and then I would compare it to exponential, and I would see differences. I think exponential is somewhat more precise compared to like a simple moving average. Because I guess the we have. Let me go back to share screen. There is an actual formula to find out the exponential moving average. Because back in the 80s, 70s, 80s, when PCs were still just coming to the mass audience, people were doing these charts by hand, right? And you'll read it in books. They'll have a big chalkboard, whiteboard, and they'll put price. Okay, Apple close. Well, we'll use General Electric. They close at $130. They'll plot it, and then they'll go ahead with their little mathematicians calculate the moving exponential, and they'll plot that next to the price, so that overall they manually just create this whole chart, and it's pretty interesting. And so this is the formula to use. Not like that I personally do it all the time, but that is how they created this. Essentially,
Yeah.
you'll see it. You'll see it visually because I'm a visual person. We'll go to a live chart. So just know that this is EMAs can be calculated by hand if need be. So let me go share into a regular chat. So we'll just go to simple, go Euro USD. We'll go Euro USD. Okay. So we'll go to a 1 hour bar. Um, and I'll go lay down a EMA. Where is it? And this is what I mean. So this is Thinkorswim. If I'm gonna go down, there's so many indicators here. But moving average. So can you guys see this? I wonder
And
if
there's
I can.
no indicators right now.
Oh man. Okay, I wonder if it can, because it popped up as a different screen. One quick. Oh, right here. Let me share this. All right, can you guys see this list on
Yeah,
the
we
left?
can.
Okay, so we have, this is a list of all the indicators that Thinkorswim, the platform, has. Tons. So I would just spend hours here just looking at, like, okay, what does this do? And then it's cool. It has this little feature where it has a quick description of what this does, right? So we're talking about moving average exponential. So I'm gonna go ahead and add that to my trading screen.
So just a reminder to everyone, like indicators is just a tool to help us analyze the current price action. It's not like a make it or break it kind of thing. Like you don't need thousands of indicators to be successful. And then there's also manual and automatic indicators. So like Glenn was talking about how these guys would do the math. Well, they programmed it into algorithms in the computer itself, and the computer or the brokerage, the trading, whatever the indicators on, what platform you're using, it automatically calculates it for you. So like when Glenn was showing that math portion, like I don't know about you, Glenn, but I've never ever done math like along those lines for any indicator. So I just wanted to keep that in mind. Like you don't have to be like a mathematician or a brainwave to do it, because thank God we live in current society where like a lot of this stuff is just automatic. However, so going back to manual indicators, there are manual indicators where like we have like the Fibonacci is a tool or indicator that you could use to buy or sell, and that's where you actually have to plot certain points yourself. So there are manual indicators out there too. That I'll show you guys like a brief after we finish all this at the
Yeah,
end.
that's
But
awesome.
yeah, I see Glenn. He has some
Okay,
EMAs up
you
right
got
now.
it
So yeah,
right. Okay,
yeah, take it away.
so we have this. We have obviously you have the regular chart. Um, we can go into candles, just for reference. So this teal line, that is a exponential moving average, and this is a there's settings. Let me show you this. Go back to here. So in these indicators, can you guys see this little setup? So it has length and displace.
Yeah, we
Okay.
can.
So I can adjust the different lengths. And so what this means is the previous 9 candles, that's where it makes its calculation. You can adjust it to 15, 20. You're going to hear other traders, they use a specific number because it's their favorite number or it's their birthday or whatever,
Yeah.
and you give them good luck. But the program just defaults it to 9, so 9 bars, and then you can just, let me go back to it, and you can see it's plotted on your chart. And what it is, it reflects, it gives you a visual aid, and it reflects the price, right? So you got the price, and then now you're like, okay, how do we use it, Glenn? It's just a freaking line on the chart, right? um, it helps you to, for one, what I use it for is to help you, give you direction on the market. So like if we look at how the market from the left just dumps, right? And then sometimes we get lost in these wicks of the candles. It could be confusing. So in this section, oh, let's zoom out. That's too much out. In this section where it's just going back and forth with price action, the EMA is like, oh yeah, we're just going back and forth here. There's really not a trend. And if you guys go back to that other Topic Tuesday we did, the different market cycles, consolidation, trending. So this is another visual tool for people to use and to identify, okay, is the market going sideways, up, or down? Um, and you can just use this as a straight strategy too. So like you can say, hey, if price closes below my EMA, I will be going short, right? And then I will exit when price goes closes above. It's just simple trading plan. If price closes here, then I will trade this. Simple plan. Now you can use more than one EMA. You can use as many as you want, but it goes back to how you want to translate it, right? So fame of a easy setup that a lot of people use. Let me go at this. Selected is they'll do a 50 and a 200. Yeah, I read 200, right?
Yep.
Okay.
Very
So
common.
let me load that up and then show you guys what it looks like. Hello.
So like yeah, another thing that comes to mind is these EMAs. They're what's considered a dynamic support. So it's fluctuating. It's like a wave. It's moving. It's dynamic. It's not static. Static support or resistance or its static indicator would be a support and resistance line drawn
Like
by you,
this green
by the trader.
one
Yeah,
or
exactly.
this.
Yeah. that
purple one.
purple
It's
line.
just it's
That's
just
that's a static support or
right.
resistance. Yeah.
So this what I did was change the settings. So the default on this trading platform it's a 9 bar, 9 candle default. So what I did is I adjusted it. This yellow EMA is representing 200 bars. It's taking the average of the previous 200 bars. And then the teal one, I adjusted it to 50. And so this this setup is a widely used strategy that you can just totally use this as your trading plan. Meaning, let's just look at an example. Let me zoom out. Okay. So we can start from here. So when price, oh, this isn't a good cross, but usually, where is it? So anyway, we can see that price. It looks like the blue EMA was gonna cross the gold EMA, but they were like just very touching. But price was dipping down and then it closed up. And so a lot of people they use this strategy like if my 50 crosses my 200 in whatever direction, I'm going to go in that direction. So it looks like the 50 starts to separate from the 200 and they're both trending upwards. So as a simple strategy, you can just be like, "Okay, I'm long. Let me go buy." Right? And then same thing, I will exit when the 50 EMA crosses the 200 EMA. You guys following so far? Okay, cool.
Yup.
So you can see the 50 EMA starts to move away from your 200 EMA. Your 200 EMA, the overall the characteristic is very since it's such a wide time frame, it's gradual, right? The reaction is way less than the 50 EMA. And so you can see if you got in long during this initial touch, right, and you're just riding it, and it's working out well so far, and then you can still stay long if you're like, okay, if my rules is I will wait till the blue line crosses the gold, I'm not gonna do anything, I will add, then at this point right here, you will close your trade. And then you will wait, and then you can see it flip. So right here, this is a cross, and you can just see clearly, okay, look, price, of course it's gonna move slower than price, right, which is indicators are lagging overall. Most almost 90, I don't know, 100% indicators, okay, because they're based off of price. You're gonna see price form first and an indicator form second. So if you're just strictly going off of this cross, you're going to get in on this second bar right here. Not this long red bar. You're going to be here. But it's all good because, that's your trading rule, yeah? But of course, there's more to it than just a trading. This is a very basic, simple setup, but you got to add more to control your risk because obviously this can happen. This big bar, if you're gonna go short, you definitely get whipped out. So um, that's something to use it for. I know Reed, you use EMAs in a different way, yeah? You're mentioning
Yeah,
dynamic.
I definitely do use like actually the very similar. I'll share my screen. Very similar. It's I don't really put too much weight on like the crosses, but I did want to point that out. And it's funny, man. We both using euro dollar. So this is euro dollar 4 hour, and same concept. I have the 200 EMA and the 50 EMA here. Um, what the way I use it though is I mainly use it for risk management or entering positions. I've been using like the 50 EMA or 200 EMA off of risk management. So when I enter the positions, and then I also yeah, so yeah, I don't go off of much about like, oh, if it's crossing, okay, I'm gonna buy or sell. But yeah, like Glenn was saying, if we go into here, this one, this cross, as soon as the 50 EMA crosses the 200, you know that it's a buy. It's a sell. I mean, a buy trending market, bull market going long. And then it just corrects. And then over here, a few days later, a couple weeks later, price drops and then it drops below the EMA, retests the EMA, and then drops and just sinks, and then the EMA follows. So, as Glenn was saying, like there's a lot more to it than to indicators, because if you're trying to get into, let's say here, but that by the time this cross happens, it well, depending on your strategy, to me, this is too late to enter the market. Whereas that's why like you want to add more pieces to the pie, like candlesticks, formations, volume, and then you could enter into a place something like here with your stop loss around the 50 EMA there, and then you could get into a market. But like again, this is all hindsight. It looks really easy and nice and beautiful, so easy to do, but it's a lot harder than it appears. So just keep that in mind, that because like this could just correct forever, and it could just whip me in, whip me out, and it could just go on. Like it's again, it's so easy. Just keep that in mind to go back when you see traders on social media talk about like, oh yeah, so I got in here. Like just be careful when people say stuff like that. That's all. Just fair warning. I don't want to like be misleading to anyone here. But coming back to EMA, so you see how these EMAs, they just kind of whiplash, break, and then they come back, and then they break, and they pull, reverse, pull back. When the price is going through EMAs like this, for me, like I just stay out of the market. It's very corrective. And like so that's just a one way to utilize EMAs, or the way I utilize EMAs. Um like when price is above the 50 EMA, it's a bull market. When the 50 EMA drops below the 200, then we're in a bear market. So that's the way I see it. I don't really and that's another thing too. I want to point out is like if I see price action is good, like I see a really nice pattern, um, which we covered in our last topic Tuesdays, and I see very nice candle formation along with volume, I'll disregard the EMA. It's one of the last things that I check actually when I try to enter the market. But when I do enter the market, I will use the EMA for risk management purposes, as in stop loss, when I'm placing my stop loss getting into the market. So, yeah,
It's good.
that's what I got.
Another, I don't know if you might hear it on the news sometimes, like those MSNBC or whatever, talking about the market, and then sometimes they might mention the term death cross. You heard of that, Ari?
Like a long term EMA is holding like a trend, and then all of a sudden price
Yeah,
drops. Usually when they're referring to price drops.
yeah. When the EMAs cross, like we were just showing you guys, when the EMAs cross, that can signify a downtrend, or they translate it to that. And if you're long only, then it's time to dip. But yeah, that was just something I remember seeing, hearing about EMAs. Um, but yeah, that's kind of a way to use those EMAs. Please explore different ones, right?
Oh
You
yeah.
can use different setups. They have the 10, the 20, the 50, the 100, 200. Um,
Indicators. Yeah,
you
you
can
can
throw
do all
some.
kinds of stuff.
Hey,
Uh,
alligator, the Larry Williams alligator, that's technically an EMA too, right? But there's just three different ones. Are you familiar with that one?
I haven't personally heard of the Larry Williams alligator. No, I haven't heard of it, but it could
same
be a
here.
form. Yeah.
Yeah, I'll Google that
That's
after.
too much already. But always like, yeah, apply indicators as you please. Um, like I know a guy, he trades like literally 20 indicators, and he's okay with that, and it works for him. He makes money doing that, but it's just it dependent on this trader. If you need more indicators, he justifies it because he needs to make sure like once they all correlate, then he knows for a fact that price will go a certain way as far as his probability goes. So again, it comes down to knowing your steps, knowing your trading routines and your habits and what you like to see in the market.
Mm-hmm.
That could be
Yeah.
one EMA or it could be 50 different EMAs or 50 different indicators. You
Yeah.
just want to have if then statements. If price does this at this indicator, then I will do this. Like those if then statements are your trading plan and are your trading rules.
For sure. It's a good template to use because it helps you keep your emotions in check. Now that's a little tricky trick right there. But when you write it down like that, when you set these parameters for yourself, if price does this and if that indicator does that, then I will take this trade. Then I will go short, I will go long. Simple. Why? Because when price is going nuts, volatility, you got the news banging on you, it's hard to stay focused. But if you're like, if you already set up yourself like, okay, this is what's gonna keep me calm throughout the storm, that'll be a more wise approach. So let's go back to the little share screen. That was EMAs. We're gonna do a little bit more live charts with that. ATR is a second indicator that we can talk about tonight. We can focus on out of the millions of indicators. EMAs, average true range. Now, average true
This is what
range.
you use, right, Glenn?
This is the thing I use, and it's a very simple indicator, and it tracks price, but it tracks the how much price moves over the previous X amount of days, whether it be 14, 21 days. For example, I mean, I can share it when I'm on the chart, but it pretty much just calculates how much price moves of a certain market of Apple or Google or Euro or crypto, how much Bitcoin moves over a span, how much did it move over 15 days ago? You know what I mean? And you're just taking that average. And what you're gonna do with that piece, with average true range, it tells me volatility. So I can go, let me go add that to this study. Okay. So let's use Tesla. Jeez. We'll go zoom in on a day. Oh jeez, and go 5 minute. 2 hour, whatever. Okay. So Tesla. Let's go focus in on today's trading price. Okay, so this is a 2 hour bar, and you see you got this big bar here. We open at 666, close at 643. Right? Big move. Tesla short. I don't know what's happening with this. I just pulled it up. So we got our EMAs here, right? For the 50 and the 200. It's just going crisscross. As you can see, just like plain and simple, this price has been in the range. Like it's just going sideways. It peaked up a little bit, popped up, and then came crashing back down. And so this bottom half of my chart is this little tan line right here is your ATR. And so, like I said, indicators are lagging, right? And so after this big bar, you're going to see ATR start to peak up. Now, I don't know if you guys can see, but at this very point, the ATR was at $9.39. So that's telling me, the way I translate it is that this bar, or the average movement of price prior to this bar, has been $9.3. Okay? And so that tells me price can either move, if it closed at 666, price can move $9 more, or price can move $9 lower. There's a good probability based on the price action previously. Does that make sense, guys? Following so far? Okay. So you use that as your volatility. Now, if you're trying to get into this market, knowing that the market can move $9 in either way, wouldn't it be wise to adjust your stop loss or your target profit to around that figure of $9, because you have more of a chance of hitting that target or that stop? I mean, if you have a wider stop loss, say your stop loss is $10 and it does move 9, you're still within the trade. You know what I mean? So let's go to a futures trade. Let's see. Let's just pull up gold real quick. Gold's another one I like using. So right here. Okay, let's just look at the bar forming right now. Say I wanted to trade, and right now my ATR is showing 4.8. So I should anticipate that price, the volatility, the amount of movement of price is either going to be $4 more from 1809 or $4 less. And it's just gonna pretty much set my parameters of like, okay, how volatile is this market? What is my risk, right? Because if the risk, oh, let me zoom out real quick. Let me show you what a volatile market looks like. In here, recently, we had it at $14. And you can see that we have these big bars here. Big moves. And so that just tells you, hey, be prepared to ride a more wild roller coaster when ATR is up. Does that make sense?
Yep.
So ATR is just measuring how much the market moves, and it gives you a feeling or a sentiment on what kind of market you are trading. So there's going to be much more calmer moves where you can have tighter stops, where it's like lower volatile ATR here, and then when it ramps up like that, you gotta anticipate and move with the markets. You know, you can't have that set stop loss of 8 pips all the time. Sometimes you gotta move it to a larger, either 20 pips. You have to adjust it according to the market. And if it's too much risk for your account, then just sit on the sidelines. That's if you want to use ATR as a indicator for your trading strategy. Because I mean, look at back in March. The example I was showing you over here was we're at $4, and then this one's at $60.
Damn.
You know, that's how much this market moved during this time. Much more volatile, right? You just look at the Dow during COVID last year. Look at this ATR. 1,600 points as an ATR compared to a low of 200 points. So that tells you if you're like trading here, 200 points is your ATR. You're like, oh, cool, you know. And you could see just representing that is smaller candles here. And then when COVID hit, ATR ramps up, the bars get bigger, right? And if you aren't aware of how volatile the market are, you're just gonna get whipped out. You're gonna be like, you're gonna try to jump in short. That's what happened to me. I went short on this market last year in like February, and then I got taken out by this big bar, I think, because the volatility was just too much. I couldn't handle. So what did I do? I just stay on the sidelines, let the big boys play. Okay,
Yeah.
they throw in billions around. They can withstand these moves, and so that's a very key thing. ATR, even though it's so simple, right? Just it just shows you volatility. Low ATR, low volatility. High ATR, high volatility, more risk. If that's
Too easy. Hey, is that a 14 day period on your ATR?
yeah, it's my 14.
Okay.
Yeah, that's a default thing. I was using 21 at one point, but you pick one and just stick with it.
Yeah.
ATR, ATR.
Nice,
Um,
man. That was crystal clear explanation.
yeah, I hope that made sense.
Yeah.
um, ATR is like I said, like this whole thing. It's another piece of the puzzle. You can try it out, see if it fits the strategy that you want to do. Mainly, ATR is tied to risk management. How much are you willing to lose? That's all. For me. And then it could be used for a target profit. Some people use it for a target profit. I mean, if you get in at a market of $100 and ATR is at 10, my target price can be 110. That'll be my target. That'll be my exit. I'm out. Totally fine. You can totally craft that as a trading strategy. Like I said, use these two different tools and then try to understand, okay, like, oh yeah, price does this when the indicators do that, and then you can do that there. Questions so far, guys?
Good.
What's up?
Yeah. How many times would you say you redone your trading plan, and how long
Uh,
does it usually take to get a wrap?
it took me a year and a half to find the strategy that I use now. I was coming up with my own little things I learned from other people, and this is a like I had to go through it in order to realize how important this part was. Finding the style slash strategy that fits your personality. Even though me and Reed trade these different styles, it fits us. There's no clear cut. Like it's all based on your personality, how much, how comfortable you are with taking a risk involved with that strategy. What's your outlook and this and that. So this is something we want to help you guys explore, showing you that okay, look, we even though Reed and I trade differently, we still can be profitable in that, right? Yeah, and you won't know until you try, right? Get your feet wet.
And journal. Dude, can't emphasize that enough. It took me too long to start really digging in and getting the stats that I needed to realize that the plan actually works. So it helps. Speeds up the journey when you journal
And this is,
everything.
yeah, this is a very good topic. We're gonna dive in more on like how to find your trading approach. We're gonna create something for you guys. It's gonna be good. Um, what I kind of just going back to that whole idea of finding your trading style, go ahead, like you can either see what we do here, or you can go find other traders like Warren Buffett or Ray Dalio or the greats, right? Like if I want to play basketball, who am I looking after, right? Kobe, Michael Jordan, right? I want to be like them. um and just really understand what they're doing that makes them, what's their edge, find that edge, right? And if that edge makes sense to you, you can understand it to a certain point, then try it out, try it on the chart, and then um, go for it. Like you're gonna start to see how it meshes with you. If it doesn't stick, it doesn't stick. Don't force it. I mean, you can force it, you can lose some money, but move on to the next if it doesn't stick. So
Lesson.
if you like sitting in front of the charts for a few hours during the trading day, scalping, catching the intraday moves, Go for it. Go for it. If it makes sense, if you feel zen doing that, that's good. But if you cannot, if your lifestyle is telling you like, look, I got other things to do, other things to take care of, maybe I'll do a longer term swing, long hold strategy.
Keep your emotions out of the market. You don't want to be trading off emotions.
Yeah, absolutely, absolutely. Just to, I mean, if you want to read, if you want to go and just share more indicators, I don't know if you want to.
Uh, I, Fib or
Or
nah, I mean, I mainly use the EMAs, man.
yeah,
That's
just use the
pretty
EMAs
much
then.
my
Yeah.
yeah. Oh, well, volume 2 actually. So let
Volume.
me just. Yeah, so this is a trade that I'm currently in. This is odd yen. I don't know where these arrows came from, man. I was messing around with indicators. Now I got some random stuff on the screen. But yeah, this is a trade I'm in now. EMAs were helped me in part of it. Put an entry here, put my stop loss at the 50 EMA. That's how I use the EMAs. And then volume was good for myself. I liked the volume. It was high bearish. So I like the market and currently in this trade. And that's one way to use the EMAs.
Do you only use
Um,
the EMAs on the hourly and 4 hour?
So yeah, only hour and 4 hour day I mainly use for why I have the daily up here is because I like to see the overall trend and just basically the power. So if I'm trying to go short here, I see that okay, the market overall is bearish. It's in a bearish run overall, converting into a full bear trend. So that's the way I look at it and use the daily. It's mainly for like a foundation. It's a very solid foundation of where it's gonna go. And then if you look at the 4 hour on the bottom left here, this is just a bunch of Fibonacci EMAs. Like I was messing around, didn't even know it was filling. So yeah, that's just EMA, a type of EMA. So this left screen here, these are what we were referring to manual indicators. So if I go fib retracement, I would actually have to draw like these lines here. You know, I got that red, yellow, green color. You know what I'm talking about.
Oh, Raja.
And then, and then, so yeah, this is the Fibonacci, and Fibonacci is. We were talking about it. This is so cool. I like it. I'll dive off a little bit. Sorry, side topic. Fibonacci. I don't even know Fibonacci. So Fibonacci is like
Look at him.
found in
He's a real
everything.
guy.
See, this is yeah, it's based off of a real guy. Fibonacci sequence is found in all kinds of nature. So that's what's so cool. Like the market is a type of nature, right? So it's the human nature. Anyway, you use Fibonacci. There's certain points in this. There's, all of these numbers you could put if you want, but it'll be super lined up. So it's not even going to come out because I put it all black, but I put 0.51, 0.618, 0.3820 just to create a range here. And again, I don't use this. Is one of the indicators that I first used a while ago. So basically, a price breaks through these indicators, creates a new high, creates a low here, bounces back off on a Fibonacci, which is the 0.382 here. Then you would buy, and you see how it worked out. It was a long here, worked out there, but then if it breaks down, retest, so maybe it'll continue short, and then but then you got to break through the 6.18 also. And once it breaks through all those lines based off of this recent high and recent low, then you're gonna look for a nice bear run. So again, I did not place this trade based off of the Fibonacci. Didn't even use it. This is all in hindsight. But it kind of just shows like Fibonacci works, right? So like if I just go back again, I'm gonna blast this 4 hours so you guys can see. So if I go here, recent high, let's get this indicator up. Recent high, recent low, prices is in this range. So goes up to 0.618, kind of rejects this area and falls back right down. Doesn't go up off of 2.382 here, but it breaks and retests it. Looks like it's going to be a short. Probability says, based on historic data, right? So I mean, that's one way to use the Fibonacci. If we go back in time, like around this area, we could see, like, if we do the fib here, this is the last example I'll show for the fib. So I'll just delete it so it's more clear for you guys. Fib again, recent high, recent low. Oh, and it doesn't matter if I draw from bottom to top, I could also like do top to bottom. Just, you want to just go off the most recent touches, at least as far as I learned this. So recent high to the recent low, and then just expand it. And so like that's how, so it's rejecting off of 0.382, broke through 0.618, kind of rejected. So broke through, went up, created this high, broke down, retested this, broke and retested. And if you just kind of just watch it, kind of just broke through, right? So again, in hindsight, it's easy to do. The hard part is actually mentally holding this. You know, if you have a position here, that the difficult part with any trading is not letting your thinking get in the way. You want it to be as mechanical as possible. So that's just another dynamic, or is it manual? It's another manual indicator that you could use. You know, I'll just throw on one more thing. You know, you could throw Fibonacci arcs. You know, like, this is nuts. I've never tried this. I've never seen it. Yeah, I don't even know how to explain this.
Bullseye.
So like, I just wanted to show you, like, it's another way. You know, if you could see this line, you see it straight, right? You just draw your line. That's why it's called the manual indicator. And then, you know, you've used that one before. This one is pretty cool. The spiral.
This is her rainbow.
So I wouldn't even know how to use this spiral, but it looks cool. I tried messing around with it earlier this week, and I was like, nah, I can't do it. All right, but anyway, there's just a couple more indicators there. Do you have any other questions, guys? You want to see a type of indicator? This is I know Elliott wave here. Like, you go 1, 2, 3, 4. Some indicators are a lot more technical. So like, you would draw this, you know, I don't know. I don't even know if I did that right. But
Bruh. The Elliott wave guys, they're like so die hard, bruh.
Yeah, man.
You're doing it wrong. They have a whole it's a theory. It's a theory on trading, essentially, guys. When you hear that, these terms, or it's a lot of it's theory.
Yeah.
Some create more probability in trades than others. But it's out there. It's out there for people to use, and there's people who do trade off of it. I know a very profitable trader that uses fibs. He just trades fibs all day, and that's his jam, because it just makes sense to him. That's his edge.
Oh,
Look at that, bro. What is this, graphics class?
Nice.
Geometry.
Geometry, bro. Hold on, that was pretty mean though.
Oh.
So yeah, just mess around with these indicators, man. It's fun, it's cool, but don't ever apply indicators to your trading without properly back testing it, because that's one way to lose money or lose in your trading. And let me take that back, because even if you do apply the EMAs to your live journal or your live market, your live what is it called, account, take note of that, and it's okay, because you took note and be like, hey man, this doesn't work, learn from this, do not trade this indicator because it doesn't fit you. So like, that's just another like tip right there.
Just adding on to that, there are studies done out there, historical studies, where, like, for example, the EMAs are talking about the 50 and the 200, There are already studies where people already did the testing, and then here's the probability of it. If you're just using these are your rules, you're gonna trade when it crosses over and then exit when it crosses back. They already done the study and they're showing you, okay, this is what it looks like. If you start off with this amount of money, this is where it's gonna be over a span of years. You know what I mean? So there are studies out there with that use these indicators and whatnot. They have actual statistics that's out there for you guys. White papers, they call it. These big hedge funds, when they find a certain strategy or they're testing it, they'll create a white paper usually, and they put that strategy through lots of data. They'll go back as far as 100 years of trading, and they'll use that strategy.
Wow.
Look at bruh.
Look at this
What is
indicators,
this?
man. So this is so as Glenn was saying, there's people that have done these studies already. So I went to my indicator button there, public library. So public library is basically all these people here. You can see the author category. These are just regular people. Maybe there's some businesses here, but they're just people creating these indicators for other people, and it's basically pre-proven. You know, I mean, look at how many people like it: 73,000 people, 54,000 people. So these strategies work, right? And they've been tested. But like coming back to it, this is one example of indicator overload, in my opinion. So like he's trading graphs, it looks like different ways to trade this. Not really I don't even know what this type of chart is. Do you know what this is, Glenn?
It's a
Like
line
this
chart.
maybe
I
a
don't
line
know,
graph
dude.
chart, but
Line
I don't
graph
know. But
chart, dude.
anyway, yeah, look at all these indicators. He has a bunch of, he got 1, 2, 3, 4, 5. This is just 5 indicators. Wow, but it looks like a bunch, right? So I mean, there's traders like this, and hey, I bet you it works for him because he seems to be a very popular author
Spent a lot of
on
time.
here. So yeah, like Glenn was saying, there's people who've done the work for you for the most part. That's also another reason why like 50 and 200 EMAs is very popular. Is because so many people have used it in the past, and so many people still use weight to it, and that's why the indicator works, because like there's so much more people putting in their money into the market at those times, at those crosses. So it kind of what is it called? It validates your position because there's millions of other people looking at the exact same chart as you are.
Mm,
So that's a yeah.
that's a good piece. Right, right. Like, um, I mean, hardly. I haven't seen it yet where you're gonna have oversaturation of a certain particular strategy, right? The crossover, the 50 and the 200 EMA. If everyone's doing it, then over time you're really not gonna have an edge because everyone's gonna jump on the wagon at the same exact time because we got the cross, and it kind of disrupts the momentum or the price action because you're gonna have too much people leaning on one side. And so like that's just a big overview of these certain indicators. But I haven't seen it personally. I like the market's so big, you don't really see that time and time through. Um, but yeah, those are the two indicators you guys can play around with. Definitely take the time and seeing like if you do find an edge there, if you guys do start observing like, okay, yeah, boom, I see that whenever a price bounces off here and I'll initiate a buy, then it'll start going my way. You know, so start formulating some sort of plan with these indicators. Like I said, it's only a piece. It's only a piece. Price action is the ultimate thing.
Yeah.
Price action, you can't ignore
Price
it.
action beats indicators.
All
And price action
100%.
is the raw data without any
100%.
indicators.
Yeah, 100%. Um, you can get carried away with indicators. We've all done it. It's fine. And like I noticed at one point I had like, let me go. I wonder if I have my old
Old
chart.
charts. Yeah.
Let me see. I've had like maybe 4, 5 indicators one time. Let me see. Currency grid. Let's try this. Oh no, that's just an EMA. So this is another EMA. Let's just do one. I was using. This was derived from one of the first trading articles I ever read in my life. It was this lady forex trader. I was telling you, Reed, this is what sparked my interest in the market. She used this exact strategy because I went back and I dissected what she did. And why is it on 2 minutes? Crazy. So she uses 3 EMAs, and they're all in a 34 EMA, 34 bars. And she would use these as dynamic support and resistance, kinda. And so I think just uh, going back from my memory, she would enter, so she would wait for price, for example, price to go, okay, boom, crossover. It was below the EMAs, and then price crossed over, closed, and then she waited for it to touch the middle EMA for an entry. And of course, look at that, to the tick, and then I don't know where she exited, but like I said, it was showing it was some sort of dynamic support where it was an entry signal for her, and then I guess when price closed, then it's time to exit. So if you're just using this strategy right here, price actions down here, you're gonna be waiting for price to go 110 to go short around there. And is that's like a just a simple setup right here too. Look at that, boom. Same thing. Price touches here, comes down, touches back. You can load up another position, dumps down. So this is a 34 EMA setup. I used it briefly. I didn't really see any success. I don't think I put it to use long enough to get a valid thing. But this is I found this from that article that I read. I still don't remember her name, but yeah, man.
What's a good amount of trades that you would consider tested? Is
I
it
go back
tens, 20,
years.
hundreds?
I go back.
I mean, like trades you make yourself.
Oh, like in the live markets, or is it like back testing?
Like back testing, live market, just trades in general.
I think, I think. I mean, it's hard to say what type of number, because yeah, it's hard. It's hard. I would say at least a half a year of 6 months of data. If you make 10 trades a month, 60 trades, that should give you a good kind of
Probability model.
yeah, good kind of model. Um, like I said, like that 34 EMA can be a signal for entry. But now, how are you gonna manage the trade after, when you got the best entry in the world to the tick? What happens next, right? That's the
Mm-hmm.
next question to ask yourself to go on. How do you manage it? Where do you exit? Do you add positions? Do you just hold it? What are you gonna do? So, this whole tonight's topics was using for technical analyzing, finding possible entries, possible exits, and risk management. The ETR kind of volatility, right?
Nice. That was
Yeah,
awesome, Glenn. Thanks.
yeah.
That's
Thank
great
you guys.
info.
Thank you guys. I know we're a little bit over time, but yeah. If you guys have any more questions, fire away. Put in the chat.
Yeah.
Oh, what was that thing I wanted to post? There is this one thing I want to post.
So, I mean, um, your plan where you stiff that and price hits here. How many different, I don't know, I guess steps would you put in it till you like it's overblown? In your opinion?
How many? If okay, wait. When you were talking about like a trading plan, you're talking about a trading plan, and
Yeah, like just with your trade management, like how would you like cut it off as far as like okay, the trade's running, I'm gonna add a position if this happens, like how many to keep true to your checklist so you're not just going random with it.
Okay. Yeah, a simple way. Okay, by the way, I just posted in the chat the Thinkorswim library. So you guys can check that out after to check out all the different indicators out there, and it gives you a description. So when you're looking at managing your trade, you're looking at exposure to the market, right? How much capital are you willing to expose in the market at that one time, right? And so you have, you start with 100% of your account, and rule of thumb, you risk anywhere from 0.5 to 2% of your capital for that particular trade. Now, so you'll hear people comfortably say, "Oh, I'll risk 5%, whatever." So what you want to do is, like, say you start off with a very small position, your initial stop loss is 0.5%, and then you're comfortable with exposing yourself 2% total, right? That means you start off with a 0.5%, and then if you get a valid entry to add on, you can add on another position. Now, your goal is to keep your total loss, stop loss, to under 2%. Does that make sense? Because of course, when you add more position, more risk you take on, right? If you're um, risking 20 pips the first trade you get in the second trade, you're adding a second contract or a second position, your 20 pips equals 40 pips now. And now you got to go ask yourself, okay, is this 40 pips within my threshold that I could withstand if I get full stop on those two positions? Yeah. And so that's your goal. Your goal is to keep minimizing your trailing stop or your total risk and throughout the market until you get to the point where, like, okay, boom, my stop is now above entry or break even. Now it's total profit no matter what happens. Then you can just let it run, right? So your goal is to stay totally exposed. You could set a limit for yourself. I wouldn't suggest more than 3% total. Like, if you got a couple of trades running, you have to do the calculations. Be like, okay, I can risk 20 pips here, and then 10 pips here, and 10 pips here. And that total collectively, that 40 pips, equals 2% of my account. Does that make sense? I lose you guys there. I should write it. I should just draw this, huh?
Yeah, well, we'll put this together
We'll
in
put
a
that together.
downloadable file.
Yeah,
Now that
that's a good
I
piece.
I understood it, but
Yeah, yeah,
we'll
that's a
we'll
lot.
simplify it. We'll simplify it with some graphics.
Thank
I,
you, Charles. We'll
That's
put
a
that
great
together.
question.
Yeah.
um, it kind of, I want to say, answer my question totally. I was trying to put it in a way, how can I put it, in your trading plan, like actually, how how would you not go overboard adding specific, I guess, routine to your trading when you're doing that? Like, do you say, okay, if it's working for me over 60 trades, stop that, don't try to reinvent your plan? Or can you keep on adding to it to where you have, instead of 10 things, you have 20 things that you have to look at before you get into something, or from opening to close of a trade?
I'll take this one.
Yeah.
A little. I'll start it off at least. Yeah, man. So, at least for me, I've found my plan always, it's an ever evolving thing with me, but I don't apply what I want to apply until, like, I've actually gained the one. It's the confidence. The confidence. So, like Ben was saying, 60 trades could do it, 10 trades could do it, 100 trades, 200 trades could do it. You just want to, one, have the confidence, but more importantly is the probability model. You want to make sure you have a winning strategy. So if you do 60 trades with just the EMAs, for example, it's just an example, 50, 60 trades, you win 40 trades out of the 60 with the EMA model. You're like, boom, I got a plan. This works. Good. I'm good. You're like, oh, but guess what? You know, I like the Fibonacci. I want to kind of add that. Maybe it'll increase my win by 42 instead of out of 40, you know, or out of 60, excuse me. You win 2 more trades. So that actually increases your probability. And so that means you're going to be making more in the long term. So as you like mature as a trader, your plan will also mature, and you could continue to add or take away from your plan. So like Glenn and I, when we first met, I had a plan, dude, that was at least an extensive 3 to 4 pages. And I kind of went counter. I actually threw everything out, and I took everything and I scaled it down to 1 single page, and it came out to 5 critical things that I realized that I did. And I didn't realize this until the end, right? Or until recently, this last year and a half, is that I only applied what fit my personality. I was like, okay, so these 5 things fit my personality. I'm gonna stick to this. So it's your personality. We all grow, we all change, we all mature, and we learn from our lessons. That's an important thing, and that goes to trading too. So if you learn something along your path, as far as a trader goes, and you want to apply it, just make sure you have the probability model that'll play out, and that'll add addition and make your trading plan better instead of taking it away. And then also the reason why you want to do that is because it'll give you the confidence that, yes, I know I could handle 5 or 6 losses and my plan will still play out because the probability works. So yeah, you could definitely evolve your trading plan.
Definitely. I'll add to that, and thank God for technology. So let me share you guys this awesome piece. This is a tool, guys. When you're doing research, when you're researching a strategy, Trend Spider, this freaking thing is bad. I tried a free trial. So they have this back testing feature. Now, so they do a free 7-day trial. You can watch the demo, but essentially, if you have an idea, say you want to see how this EMA strategy works on specifically the euro dollar over 2020, you can run it through this model, through this tool, this online platform. You can input, okay, sell at if price does this, same thing, if and then. It's gonna give you a little template, and you just input the targets. You're not really coding, you're almost coding, but what it is you're gonna give the computer inputs and outputs, entry and exits, pretty much, and then you're gonna be like, okay, I want to test over a year on this market. You hit the click button and it'll run all those trades that meets your criteria, and then it gives you a percentage long, percentage short, win rate, lose rate. And this is just a base for basic entry. It's not really, I haven't gone too far where it tests where you scale up and scale down on your trades. This is just a simple tool where it brings down this research to minutes rather than going chart by chart before over here. So this is a snapshot of what it does. So you have a 1 hour chart, and then it gives you, when you do the whatever strategy, it shows you, okay, boom, this is what it looks like, entry here, exit here, this is your percentage gain, percentage loss, and then on the bottom left, bottom right, they give you your analysis over time, and it kind of just forecasts your account simulated whether it grows or goes negative by this one strategy that you're testing, you know what I mean, in this one market. So like these kind of tools are out there. It might be it could be a lot right now, could be for especially for just starting, it could be a lot, but it's out there, and it just saves time. It saves time when coming up with, instead of you taking 6 3-6 months to come up with your 60 trades, because at the end of the day, you're looking for probability, right? You're looking for, okay, give me the stats. I want the stats. And there's tools out there like Trend Spider that give you the stats right away. It could potentially save you money, but it's there. It's there. Cool.
No, those are good questions, Charles. Got our
Definitely.
brains thinking.
Yeah. Yeah.
But man, yeah, we should call this though.
Yeah. Yeah. I mean, appreciate
We
you
don't want to
guys
take any
jumping
more
on.
of your time. Yeah, thank you.
You guys gotta bounce. Thank you guys. Thank you guys. We'll
Shoot.
be continuing this next Tuesday. Same time, same place. Woo woo.
Oh, have a good one.
Have a good one.